Hello, I'm Dr. Cheryl Dunn. I'm here to demonstrate a problem for you called Badgelakers, Inc. It's a fictitious company, and in this problem we are asked to evaluate a contract and determine how many performance obligations are in the contract, and then how the transaction price should be allocated among those different performance obligations, and then to record journal entries on several different dates for the company. So take a look at the problem. Pause the video for as long as you need to read it. Okay, in this contract, we actually have three performance obligations. One is for the computers themselves, the tablets. One is for the extended warranty. If this was just the normal 90-day warranty that came with it, we wouldn't be counting that as a performance obligation. That would be considered a quality assurance obligation or a quality assurance warranty. The extended warranty is considered something, because it can be bought separately, it's considered something other than just quality assurance, and it would be considered a separate performance obligation. And then the technical support, again, because that is something that can be purchased separately, that's considered a separate performance obligation. So there's three different performance obligations in this contract, and we're going to take a look at allocating, therefore, the transaction price across all three of those. The total contract price in this example is $4,800, and that includes 10 of these tablet computers along with the extended warranty and the tech support. And we need to distribute that among the three things. In order to do that, we need to first start with the price of each thing separately. So we'll look at just the price of one tablet computer, the extended warranty of $80, plus the tech support for $60. If we sum those together, we get $540 as the total price that somebody would have to pay for each tablet if they were to buy these three things separately. Of course, if you multiplied that by 10, you'd have $5,400 as the total that they paid $4,800 for. We then take each separate component as a percentage of that $540. So if we divide the 400 by 540, and then divide the 80 by 540, and then divide the 60 by 540, that tells us what percentage of the total contract that each of these components makes up. 400 divided by 540 is going to be 74%, or 0.74. 80 divided by 540 gives us 15%, or 0.15, and 60 divided by 540 gives us 11%, or 0.11. We add those up to verify that those do add up to 100%, or 1.00, and in fact they do. What we then do is we multiply the 4,800 by each of these percentages. And so if we multiply the 74% times 4,800, that gives us 3,552. The 15% times the 4,800 gives us 720. And the 11% times the 4,800 gives us 528. If we add those together, we can make sure we did the math right, and those do indeed sum to 4,800. Now, why was it important for us to separate these components? It's because the tablet computer revenue, we're going to recognize right away. As soon as we deliver those tablets, we've earned that revenue. On the other hand, the extended warranty and the tech support are going to be earned over time. And so we're going to not record those as revenue upon delivery, but rather we'll record those as revenue across the time that we are earning it according to those performance obligations. So the warranty will be earned over the course of 2 years, and the tech support will be earned over the course of 3 years. Now, they asked us to determine what journal entry Badgelakers would make, first of all, on December 28th, and then on the delivery that happens on January 3rd, and then on January 15th when they receive the payment from the customer. So first of all, on December 28th, when the client placed the order, there's no journal entry to be made. The customer promised to pay for the tablet computers and the extended warranty and the tech support. Badger Lakers promised to provide those things, but no money has changed hands and no assets have changed hands. So there's no journal entry to be made. On January 3rd, however, once those tablet computers are delivered, now we've earned part of the revenue. Badger Lakers has earned part of the revenue. So they're not going to record cash because they haven't gotten the cash yet. That means they're going to have accounts receivable. They're going to have a total accounts receivable of the $4,800, the total contract price. But again, we can't recognize revenue for all of it. So we're going to recognize sales revenue only for the portion that was earned upon delivery, which was this $3,552. Then we'll record deferred revenue, and we'll go ahead and split it into two accounts just because that will make it easier to monitor over time. So we'll set up a deferred revenue for the warranty, and we'll set up a deferred revenue for the tech support. We'll credit the deferred revenue on the warranty for the $720, and we'll credit the deferred revenue on the tech support for the $528. That makes our journal entry balance, and we now have the revenue that we've earned, and then of course these deferred revenue accounts are actually liabilities. They show that we owe the customer the warranty service and the tech support service. Over time, they didn't ask us to do this, but over time at the end of each month, we would take a monthly portion of this and record it as revenue and decrease the liability. The final entry they asked us to make is January 15th when we receive the payment from the customer, and when that happens, they would simply debit cash and credit accounts receivable for the $4,800. That concludes this demonstration. Thank you for viewing and have a wonderful day.